For more on the markets right now, we want to bring in Tom Kennedy. He is chief investment strategist at JPMorgan Private Bank. And Tom, the hot PPI and CPI numbers that we got for this most recent month have a lot of people questioning whether we really are going to see a soft landing, whether the Fed's going to be able to cut rates. You're still a true believer.
Yeah, we certainly are. It certainly challenges a soft landing, without a doubt. But when you look at underneath the surface of the inflation data, what are you seeing? Is goods-based inflation was deflationary for a period of time, bottoming out. So we're through that phase. The COVID-induced inflation rebound, if you will, it's hard to say that with inflation coming down, that seems to be behind us. But as we start to look forward, it's all about the labor market. And inside the labor market, we've just gone through a generational surge in labor supply. And that's from a domestic sense and from an international sense. Domestically, work-from-home behavior seems to be here to stay. A LinkedIn survey from last year, which was the first real test I've seen in a normal time. 2023, what about you guys? I wasn't wearing masks. I was going out. Everything was fine. 50% of all jobs filled on LinkedIn were either hybrid or full work from home. That's here to stay, so it draws people back into the labor force.
When you start looking at what happens next with the markets, you're looking for a change in leadership. You do think the mid-caps are going to step up and take over the reins?
I think there's a really big opportunity to see a broadening in this rally. The concentration in performance in U.S. tech has been stark. We all talk about it. But really, since October, when that Fed pivot came into fruition, S&P tech sector has led, and at the same time, Russell 2000 and mid-caps have outperformed. It's quite odd, given that the tech concentration is so low. I think it can broaden out for a few reasons. Earnings should move from, in the mid-caps, from negative last year to plus 10 this year. Valuations are relatively cheap. And there's a heavy concentration in industrials, which is where the U.S. government is spending. And even if we get a change in leadership at the president level, it looks like that spending should be durable.
Okay, what if the inflation picture really doesn't tame down anymore? I realize it's only 2 months that you've seen CPI and PPI higher, but if you're not going to get back to 2%, that means the Fed's not going to be able to cut rates. And it seems like a lot of what we've seen, the frenzy in the market, has that as a predication.
Yeah, I agree with your point. I think this is one of the biggest risks the market is dealing with. That's why we spend so much time talking about it. The path towards the disinflation, I think, is that labor surge. The Fed, I don't think, needs to wait for 2%. Just confidence that they can get there.
Well, confidence that it's not going to go above 3%. And at JPMorgan, Jamie Dimon has been the one saying, I don't think they should cut rates yet, that there's more concerning things coming potentially. Yeah,
Jamie is a steward of the fortress balance sheet. He's always worried about what the risks are. We're in the room trying to help him figure those out. My job is to help clients navigate what the most likely scenarios are. The immigration surge is one we haven't talked about yet. A generational shift as well. 1% of the U.S. population last year was from immigration. We haven't seen population growth like that since 1910. Now, to bring the election in here, that stalled because we had a literacy test that slowed immigration. That's a risk here, too. But to really think the labor market is going to retighten.
Slowing immigration is a risk?
Yeah. Inside the election, this is one thing that really separates President Trump from President Biden in the way that they've handled immigration.
But you're saying that open borders are a good thing, or?
For the U.S. economy, they're fantastic. From the Fed's perspective, to tame inflation, immigration is a fantastic thing for them. You're getting the calming in the labor market just from the supply side rather than having to lay folks off. It's a fantastic opportunity set for them.
Wouldn't you like to see legal immigration instead?
Most of the immigration has been legal. I mean, this is always hard to see in the data exactly, but the Biden administration has ramped up visa and immigration from a legal sense, and of course there's been illegal immigration as well. But this is one of those places, as we look to the year ahead, where economics and politics really intersect. And for investors, I think we generally look around in history and say, the elections don't matter. But this might be one instance where it does matter, because we've been very lucky to have immigration that has cooled this labor market the way it has.
And you think that's just misunderstood by the American public?
No, I just think it has political factions to it that are beyond just pure economics. In any Gallup poll we look at, it's the biggest issue for Americans is immigration. And so it's polarizing. But if you just look at a simple economy, if you see strong demand for jobs, you can cool that in two ways. Bring more people to the workforce, or you have to cool that demand.
But then there's the second order effect, which I think is what Becky's referring to, which is the legal immigration, which has been ramped up.
Yes.
Plus the illegal immigration.
Absolutely.
You could argue the illegal immigration, by the way, is also good for the Fed. I mean, I know that sounds completely perverse, but it's the case.
Yeah, I don't think it's perverse. I'm agreeing with you wholeheartedly. You need a balanced labor market to be confident that inflation won't surge back to 3%. And the labor supply has helped quite a bit.
Let's pivot quickly just to talk about the lending situation right now. You were making the point that private lending has been pretty good. If yields continue to climb, what will that mean?
You're starting to see a reopening in financial markets. And from the Fed, when they meet next week, the realist there, the person who's saying, I'm not so sure inflation will go back to 2%, they will look at the IPO market ramping up or opening again, and lending practices go up. Yeah, if rates stay higher for longer, we should continue to see lending activity be subdued and not ramp higher. But I think the market is giving private credit, the private direct lending, the market I'm worried about that. That's a bubble. But when I look at what a bubble is, Becky, it's debt growing in excess of profits, right? A simple definition. And in the aggregate finance market, you're seeing profits up, lending activity track it as well. Just private credit is taking market share from high yield and loans so far.